And I'll go over the first part with them individually. Okay, glad you mentioned that. Thank you, Carter. It's so easy to forget to do that. I'll go back here to sharing my screen. Looking at Roman numeral 2, financial statement cycles. Well, thanks to double entry accounting, each transaction affects at least 2 different accounts. And the audit thus makes sense to audit interrelated accounts simultaneously. And groups of interrelated accounts are called financial statement cycles. So table 6.2 on page 155 depicts cycles and the accounts involved. Let's just glance at that. Cycles, and we'll study some of these in the second auditing course, like the sales and collections cycle. So in that, we would audit all the unrelated accounts simultaneously, like sales revenue, accounts receivable, acquisition payment cycle, acquisition or purchases. So we would audit, in that case, inventory, accounts payable, cash disbursements, all at the same time. That's all I wanted to show you from this. I won't test you on it. Then, looking at C here, we can also note or see the transaction flow from source documents to journals to ledgers, trial balances, and financial statements on page 153 of our textbook. Yeah, so here in figure 6.4, simply showing the accounting cycle, starting from transactions to journals, their general ledger and subsidiary ledgers, to the general ledger, trial balance, and finally financial statements. Just wanted to show you that. Again, I won't test you on it. Then, Roman numeral 3, management assertions. So these are the qualities management says are true about the financials. And now one big overall assertion is the financial statements are fairly stated in accordance with GAAP, but we'll break this down into some subcomponent assertions. And we'll see those are divided into 3 categories. So when management hands us those financial statements, they say or assert they conform to GAAP. Well, what are they really telling us? I mean, after all, they say those financial statements are fairly stated in accordance with GAAP, and that is a great big statement. But they're really saying a number of things that are going on behind the scenes. So we need to see what those smaller things are that they're really telling us. So we'll go over these. And in this class, there are not many lists, which I expect you to remember. But this is one list you do need to know. The reason is we have such basic terminology here for audits. And we're expected to know these things right away, off the top of our heads. So if you will, please make sure that you do understand the list here. And you know these very, very basic terms. They're not difficult, but just know we've got some memory stuff to worry about here. Memorization, that's okay, not difficult. Now, the first list of assertions we see here are about classes of transactions and events for the period under audit. So we're thinking here about individual transactions, individual events. What kinds of things will management say are true about individual transactions and other types of things? First thing they're going to say is occurrence or existence. They're going to tell us that balance sheet items exist. An income statement items occurred for the appropriate balance sheet date, an income statement period. No extra items are recorded. Thus, the financial statements are not overstated with extra items because all recorded transactions actually occurred. So occurrence or existence, nothing is overstated. So whenever you see occurrence or existence, think no overstatements. Now, the mirror image of that is completeness. So completeness. The books are complete, as all transactions have been recorded. Thus, the financial statements are not understated due to not recording a transaction. So if we think here about completeness, completeness is exactly the opposite. Completeness says everything has been recorded. We have not omitted something. We have not left something out. So whenever you see completeness, think no understatements. So you see the mirror image of these two. Another reason I stress that is because on the CPA exam, they often test that very concept. They know that under test pressure, some people taking the CPA exam will do what? Well, exactly. They'll flip them around. Easy to do. We won't fall for it, will we? No, not us. I really keep track of these little tricks they sneak in. You know, it's not just enough to know the material, but also we need to know how to take the test. So I really do feel that by keeping track of these little tricks helps our CPA exam pass rates. We have really, really, really good pass rates on the audit, except mirror report and stuff. We truly do. So, and you all will keep that correct. Okay, good. I'm going to some enthusiasm. Yeah, I'm sure that you all will. Now, number 3, accuracy. Are transactions recorded at the correct amounts? Are the right amount of dollars there? That's pretty easy. Number 4, this was easy too, classification. Are transactions properly recorded in the correct accounts? And are account types properly classified, such as asset or liability or short-term versus long-term? Okay, that's easy. Then number 5, cutoff. Are transactions, especially those around fiscal year end, recorded in the proper accounting period? Note the ending account balances would be misstated if transactions are recorded in the wrong accounting period. So right around fiscal year end, let's say it's December 31st. We need to make very certain that we record transactions in the correct year by recording them on the exact date they took place. Otherwise, we could flip that transaction between the 2 years and get it wrong. We could have a cutoff error, in other words. In the middle of the year, it does not matter if we don't record a transaction exactly on the day it took place. The fiscal year end, it does matter. That's when we're careful. Does that make sense? In the second auditing course, we'll get into some specific cutoff errors, especially with sales. Now in B, another group of assertions, this time about account balances. So we're talking about the ending account balances, and especially real or balance sheet accounts, because those have balances that roll over from 1 year to the next. They're the real account balances. We want them to be very accurate, quite frankly. So here comes something that will sound familiar. This time it's usually called existence, but same thing as occurrence. Refer specifically to the existence of ending account balances to make sure they're not overstated. So every dollar in an ending account balance belongs there. It exists validly. So again, no overstatements. Well, then number 2, completeness. Refer specifically to the completeness of ending account balances. They're included in the financials. They're not understated. So completeness. That sounds really familiar, except this time applied to the ending account balances. So every dollar that belongs in the ending account balance is there. That ending account balance is complete. So again, no understatements. Then the next one, valuation or allocation. It means the amounts in the financial statements are valued properly, normally at historical cost, and revenues and expenses are allocated at the proper period. So revenues under the revenue recognition principle, expenses under the matching principle. Also, it says that any value adjustments, such as the allowance for bad debts or the allowance for accumulated depreciation, have also been included. Then number 4, rights and obligations. It means the entity has rights to the recorded assets, they own them, and the recorded liabilities are its obligations. They owe them. And we can note the auditor is more concerned with rights to assets if we think about management's motivations. In other words, let's say this client lists an asset on its balance sheet, doesn't necessarily own the asset. Maybe not. They would love to overstate assets, listing some they don't own. On the other hand, they list a liability on the balance sheet. Do they probably owe it? Yes. Because why did they list something they don't own? Then if we think about rights and obligations, sometimes people refer to this as ownership because, again, we're more concerned about whether management owns those assets. Then a final group here, assertions about presentation and disclosure. So parenthetical disclosure, footnote disclosure. And I think these will be straightforward to you as well. One is occurrence and rights and obligations. So if disclosed events occurred, are they the rights and obligations of the entity? So if they really occurred, usually yes, they have. But what's more of a problem is number two, completeness. Have all required disclosures been included in the financials? Sometimes they're not all there. That can be a big problem. So completeness is always the biggest problem when it comes to presentation and disclosure. Presentation and disclosure may be understated. In other words, not everything is there that should be. Then number three, accuracy and valuation. Is financial statement information disclosed fairly and at the appropriate amounts? So we want to make sure, for example, if they mention a dollar amount in a footnote, that sure enough, that ties back to the financial statements. It's the correct dollar amount. Then the fourth one, classification and understandability. So are amounts properly classified in the financial statements and footnotes? Are balance descriptions and related disclosures understandable? So make sure that people can read them okay. Any questions there on any of the management assertions? So anything there on management assertions? Or do things seem pretty straightforward? Straightforward? Okay, good. Good, thanks, Mary. Now, we'll see how the auditor goes about checking up on these. And before we do, I think I'm actually going to take a section out of sequence. I'll show you what I mean here. I want to go back to sharing my screen. So if you're online. Going to come down to the last section here in the chapter 6 notes. Section 5, a brief overview of the audit. I think if I do, this may help make some things fall into place about the audit objectives. So let's see a brief overview here, a lot of which we've seen before. That's okay. Now, first, we're going to see the 5 basic types of audit tests in this overview of the audit. We've got 2 tests pertaining to internal control. So 2 tests the auditor conducts. How well is internal control working? Well, we'll do procedures to obtain an understanding of internal control. Those are basic ways to get acquainted with internal control. We do these early in the audit so we know how good or how bad internal control is. We hope it's good. That means less audit work because the financials are probably okay. If internal control is bad, that means more audit work. Financial statements are probably not okay. And then test of controls. That's where we get into individual transactions. We see whether internal control has been followed over each one. For example, if we have an individual sale, we'd like to make sure the credit's been approved for it. We will go in and look for a credit approval number. That sure enough, the customer's credit's been run, it's okay to sell to them. That credit approval number is missing, that's bad. We'll expect more problems, probably in the end, more uncollectible accounts receivable. Then we've got three types of substantive tests. Substantive means that we are substantiating a dollar amount. So in these three, we are checking up on individual dollar amount of a transaction. We're checking up on an accounting number. One type will be analytical procedures. So in analytical procedures, we'll see a little bit later in the course that these are quick and easy tests for reasonableness. For example, if we run a set of financial ratios on the client and compare these cross-sectionally to the client's industry, making sure things look pretty much the same. If they don't, we suspect problems. Or if we compare these financial ratios over time. Over time, looking at the client's past financial ratios, I'm looking for any unexpected changes. If we see unexpected changes, then we start thinking we've got problems. Well, then, substantive tests of transactions, substantiating the dollar amount of one individual transaction at a time. And then tests of details of account balances, where we're substantiating the ending balances of real accounts, balance sheet accounts, in other words. A really good example of this would be if we are checking up on accounts receivable and we send the client's customers a special statement of their account called confirmation. Is this your correct balance or not? If it is, that's great. If not, let us know. Whereas a substantive test of a sales transaction, an individual transaction, the previous test, that would be where we're checking an individual sale, tracing it to the sales journal to make sure there's no posting error. Now, let's think about some phases of the audit here and how these tests would come into play. One phase of the audit is the planning and design phase. Well, that includes obtaining an understanding of the client, its internal control, and its business environment. So we're getting acquainted, making some preliminary assessments of control risk. In other words, how good is internal control? And the risk of material misstatements in the financial statements. Does this client have an exceptionally high risk they could have material misstatements, or is it low? We hope it's low. We'll budget the audit, we'll assign personnel, we'll develop the audit program. So we do that early on. And also early on, we do most analytical procedures. So we know where problem spots might be. So analytical procedures, they provide a quick overview of where the financials may be misstated, so that the audit resources can be deployed accordingly. And financial ratio analysis is a really good example of this. Analytical procedures are substantive tests since they deal with monetary amounts. By the way, the textbook sounds if analytical procedures are conducted much later in the audit. However, analytical procedures are actually conducted at various points in the audit. And most analytical procedures are performed early in the audit so that the auditor is going to know where problem spots lie. And analytical procedures may thus lead to revisions to the audit program. So if they stack up, like over time, the client's financial ratios are pretty much the same, that's good. Because we usually expect them to be pretty much the same over time. If we see sudden unexpected changes, that's when we suspect trouble. We'll dig into things a lot more in the audit. Means a lot more evidence gathered. Yes, Carter.
Auditors do cases like GameStop, Tesla, ACC, their financial ratios change. Something like that.
that would be a big problem in the audit. If you would have to justify those changes. And if you can justify them, that's good. If you can't justify them, that's when you've got trouble. That sure would mean a lot of work if they're changing that rapidly. Anything else so far? Alrighty. Well, then the next phase, shall we say, is testing internal control. It includes test controls in order to assess control risk. In other words, the risk that internal control will not prevent or detect a material misstatement. If that's high, that's bad. It could range up to the maximum of 100%. That means we're 100% sure that internal control will not prevent and or detect material errors. That's bad. If it's lower than 100%, that's good. That means internal control is working, at least to some extent. Yes, Carter. Yeah, but that's pretty close to 100%. It's still really bad. Yeah. So if control risk is 99%, we're probably going to see it's not a material difference from 100%. Yeah, it's bad. Moving on, the auditor ascertains whether internal control is working by testing individual transactions through test controls. If control risk is low, that's good. It can reduce substantive tests, especially tests of details of account balances. Now, some tests of details still must be performed, but if we have something like confirmations of accounts receivable, a test of detail, the lower control risk is, the fewer of these we must send out. They get to be expensive. So lower control risk can save that client a lot of money. Again, that's because there's some assurance already that the accounts are probably fairly stated. And test controls are often done at the same time as substantive tests of transactions. If we do, we call those dual purpose tests. For example, at the same time that we take those individual sales transactions and we trace them to the sales journal to make sure there are no posting errors. That, by the way, is the substantive test of transaction part. At the same time, we may as well do a test control. We can look for the credit approval number at that time. That would make that a dual purpose test. Combination substantive test transactions and test controls. Is we'll kill two birds with one stone. And also the term tests of transactions refers to testing individual transactions, either as test controls or substantive tests of transactions or as dual purpose tests. A little example there, you can read on your own. Then E. The next phase, we usually try to save it until after the other tests, is tests of details of account balances. We try to save these until after the other tests because we're hoping that we're going to be able to reduce tests of details a little bit. They're usually quite expensive. So those accounts receivable confirmations sent to individual customers, if we can reduce the number of those, we've saved the client a lot of money. We hope we can, because we hope that those earlier audit tests turned out good. So reading on about these, they're performed again primarily for the real or balance sheet accounts. And that's because test of details are substantive tests for the ending account balances. And only the ending balances of real accounts carry over to the next fiscal year. Generally, test of details are the most expensive type of audit tests, so as we know, the auditor tries to limit them if the results of the other audit tests are good. Thus, tests of details are usually performed after the other audit tests. We'll see more about that in later chapters. And then F, finally, we'll reach conclusion as to whether the financial statements are fairly stated in accordance with GAAP. Excuse me. And we'll write the appropriate audit reports. So questions there so far?
Dr. Quaylen, I know you mentioned that we'll need to learn like the list assertions about classes of transactions. Do you need us to be familiar with the other two lists, the assertions about account balances and assertions about presentation and disclosure?
Yes, you should know them.
Okay, thank you.
You're welcome. Anything else so far? Righty. So now let me come back up to where I left off. Roman numeral 4. So we saw those management assertions, those things that management tells us are true about the financial statements when they hand them to us. Those are all well and good, but we've got to check up on them. We can't take them at face value. We're professionally skeptical, so we don't fully believe them until we see evidence to back them up. So that's where the auditor's work now comes in the way of evidence gathering. So to guide us through the evidence gathering process, we've got some audit objectives. And again, I don't expect you to memorize many lists in this course, but this is one that you really do need to know. Very, very basic terminology for audit. So the auditor must now gather evidence to determine whether management's assertions are fairly stated. And we'll now examine the audit objective, which guide the process. And we'll discuss general audit objectives. They can be applied to any account. And later chapters, we'll discuss specific audit objectives, which are customized to individual accounts. And the general audit objectives are divided into 3 categories: transaction related, balance related, and presentation and disclosure related audit objectives. Well, again, just like the management assertions. In fact, a lot of these audit objectives will sound just like the management assertions. The difference is that these guide the auditor's work. So here's how we check up on what management says. Do they tell us the truth or not? So first of all, the transaction related audit objectives. They apply to auditing individual transactions, not surprisingly, like the assertions. And this will be accomplished through substantive tests of transactions for substantiating the dollar amount of an individual transaction. And there are 6 of them. They basically correspond to the management assertions about classes of transactions and events for the period under audit. First one, not surprising. Occurrence, sometimes called existence. It's analogous to the existence assertion. Do recorded transactions reflect what actually occurred? Are there any non-existent or invalid transactions? Note that invalid transactions would overstate the books. So once again, we make sure that all transactions exist. There are no extra transactions. There are no overstatements. So always think no overstatements here. Now, the next one, not surprisingly, completeness. So it's analogous to the completeness assertion. Are all transactions recorded? If not, the books would be understated. So again, completeness, always think no understatements. Then the next one is accuracy, or valuation, sometimes called. This one's not surprising. In fact, none of these will be. Are transactions recorded at the correct amounts? Primarily refers to freedom from mathematical errors. Also assumes proper basis. Normally, historical cost was used. And we can note that accuracy does not always overlap with the existence of completeness. For example, recording a transaction twice violates existence. Accuracy would be violated only if the dollar amount of the transaction were misstated. Does that make sense? So we have a cash disbursement transaction for $1,000. That $1,000 is correct, but we record it twice. We've only violated, in that case, completeness. I'm sorry, we've only violated, in that case, existence or occurrence, because we overstated our cash disbursement transactions, albeit for the correct amount twice. Accuracy would be violated only if that dollar amount were something other than $1,000 that's recorded. So only if we messed up that dollar amount of the transaction. Does that make sense? Okay, cool. Then classification, not surprising, are transactions properly classified according to account and account type, such as asset or liability, or short-term versus long-term. Sounds really familiar. Timing, this will sound familiar. Are transactions recorded on the dates they took place? They should be. If not, we can really mess things up at fiscal year end with cutoff errors. Then number 6, posting and summarization. Are transactions correctly transferred from journals to general and subsidiary ledgers? Thus, there are no posting errors. And the account part of the posting overlaps a little bit with classification, making sure it's classified according to the proper account name, proper account type, like short-term versus long-term. And also, are transactions and books properly summarized, their FUD, etc. Overlaps a little bit with accuracy. That's okay, these are not mutually exclusive. And that takes care of the transaction-related audit objectives. So do you have any questions there about those so far? Any questions? It's pretty straightforward. Good. I told you this chapter would be. I don't lie. Unless I really, really have to. Actually, not even then. I have trouble lying. I'm not a good liar. Yeah, pardon? I'm not a good liar, I said. I wasn't raised to lie.
You said something before that.
I'm not a good liar. I only lie if I have to. Is that it? And even though I'm not good at it.
I'm not sure, but
Okay. Yeah, I wasn't really raised to lie, so I'm not good at it. A lot of people are a whole lot better at it than I am.
They don't follow the 10 commandments, what the commandments. Thou shalt not lie.
Absolutely. And you were raised that way too, Mary.
Yeah.
It's obvious. I think it's obvious we all were.
Mhm.
All right, so nothing else so far. Okay, let me go back here to sharing my screen. Well, here I've got the balance related audit objectives. That list sounds familiar. Just like the management assertions, and they apply to auditing ending account balances, especially those balance sheet accounts, the real accounts. And this will be accomplished through tests of details of account balances. And that's another type of substantive test, as we know. Substantiating the ending balance of real accounts. There are 8 of them. They basically correspond to the management assertions about account balances. And one reason we're concerned here about the balance sheet, we mention a lot, it's really the most basic financial statement. It's the starting point of the audit. Its balances carry over to the next fiscal year, so we want them to be very accurate. Well, the first one, not surprisingly, existence or occurrence. Same as the transaction-related objective of existence, except applied to the ending balance of the account to make sure it's not overstated. As an example, failing to record a cash disbursement would violate the transaction-related objective of completeness. Cash disbursement transactions would not be complete as they would be understated. I'll show you this on the board in a second. Would violate the balance-related objective of existence because the ending balance of cash would be overstated. Let me stop my share for a moment and show you that up here on the board. So on Saturday, I found I've only got one really good marker in here. I need to bring down some better markers from upstairs, although I know that some professors are going to leave the caps off, gesture around with the marker, let it really dry out. That's what happens. On Saturday, I found that this double marker, the red is really good on it. So let me hope that whichever professor is waving these markers around doesn't discover the red one. I think he or she has already discovered the green one here because it was pretty well dried out. That's Carter. That's right. I need to hide it or have it over in my office and bring it to class, but then I forget. So I think your suggestion is much better. I need to hide it. That's right. And this marker, as we said, it looks a whole lot like a love bug. Okay, let's illustrate this example. We failed to record a cash disbursement. Okay, let me make sure here that I apportion my board space, which I always need to do as I teach online. Here.
You're in good width.
Sorry.
You're in a good spot right there.
Okay, thanks, Mary. So let's see, as I so let me draw a T account up here for cash. And we committed a oopsie there. We forgot to post a cash disbursement transaction. So we have understated. I'm sorry, cash disbursements. Let me get it on the right side here. Okay. So on the credit side, we've understated transactions. We have violated, as I have in the notes, the transaction-related objective of completeness. That's because cash disbursement transactions are understated. We forgot to record a transaction. However, if we were filling this account, totaling it up, we would find the ending account balance has been overstated. We have violated the ending account balance in terms of overstaying it. That means that when it comes to the balance related objective, we violated occurrence or existence because we overstated the ending account balance. So does that contrast make sense? Okay, good. So this ending account balance has been overstated. Well, we sure don't want asset accounts to be overstated as an auditor. We know the client's motivation is to overstate them. Same thing for revenue and loss accounts. Don't want them overstated. Too risky. What the client would love to do if the client were committing accounting fraud. Virtually every accounting fraud has done that, among other bad things. Let me come back here and just look at the rest of the notes here under that.
Professor Quaylen, Dr. Quaylen, you said
Yes.
that when you overstate the recorded transaction, therefore the ending account balance will be overstated. That's
Mhm.
an occurrence of existence, correct? Because you did not,
Mhm.
that's an occurrence of existence?
Yes, we violated the balance related objective of occurrence or existence. Mhm.
Okay, because I thought you said completeness, but I wanted to make sure it was occurrence of existence. Okay.
No problem. Anything else? Okay. Well, our next objective is completeness. So same as a transaction related objective, completeness, except again applied to the ending balance of the account to make sure it is not understated. As an example, recording cash disbursement twice would violate the transaction related objective of completeness. Cash disbursement transactions would be overstated, so the account, the second entry would be non-existent. Would violate the balance related objective of completeness because the ending balance of cash would be understated. So let me show you this. I'm going to stop my share here. And let me come back up here to my T account. So this time we took a cash disbursement transaction. We recorded it twice. We've overstated our cash disbursements. Okay. So we violated the transaction related objective of occurrence or existence. We've overstated those cash disbursement transactions. On the other hand, we've understated the ending balance of cash. So we've understated the ending balance of cash. As it turns out, that means that we violated the transaction related objective of completeness because we understated it. So everybody with me there on the contrast. Okay. That will help you always sort out existence versus completeness. And again, those concepts are really important to get down pat because the CPA exam knows that a lot of people mess those up under test pressure. And we will not be some of those people, correct? Correct. All of us will get at least 75 on the auditing section the first time, correct? Yes, you better believe we will. Yes. Also, as I had there, that's very important for liabilities and expenses. As an auditor, we do not want their ending balances to be understated. That's bad. Well, then the accuracy objective, sometimes called valuation again, not surprising, it's really the same as the transaction-related objective of accuracy, except again, applied to the ending account balance. And then classification. Same thing as the transaction-related objective classification, except again, applied the ending account balance, making sure that those ending balances have been properly classified. Cutoff, this was not surprising, it relates back to timing of fiscal year end. Related to the transaction-related objective timing, are transactions, especially those around fiscal year end, recorded in the proper year. We note the ending account balance will be misstated if transactions are recorded in the wrong year. Very, very critical for sales and inventory in transit fiscal year end. That's why in financial accounting, you talk a lot about inventory in transit at fiscal year end. Then number 6, detailed timing, sometimes called mechanical accuracy. It's related to the transaction-related objective of posting and summarization, except it refers to monetary agreement of compiled accounting records with each other. And do the books balance? We're always asking that. Are account balances properly supported by master files, as your book says? Generally, in accounting, we say subsidiary ledgers. The term master file is a relational database term, just to let you know. And schedules. For example, the accounts receivable trial balance of the subsidiary ledger agrees with the balance of the accounts receivable general ledger control account. Everything stacks up. Everything matches up. All the details tie in together. Then number 7, realizable value. Well, if any declines in market value of impaired assets been properly recognized. For example, inventory should have been written down to realizable value due to damage and obsolescence. If not, we violated the realizable value objective. Inventory should also be valued at order of cost or market. Also, accounts receivable should be stated at realizable value, namely gross accounts receivable less the allowance for bad debts. If not, again, realizable value has been violated. Then number 8, rights and obligations or ownership. Does the client own the assets and owe the liabilities as of fiscal year end? Of course, note the auditor would spend more time on whether the client owns the assets than whether the client owes the liabilities, given management's motivation. Again, we know if they list an asset, they may not own it. If they list a liability, they probably owe it. And the final thing here in the chapter, we made good time today. Presentation disclosure related audit objectives. And these are the same names the management assertions about presentation disclosure. We already know them. Questions there about chapter 6. On chapter 6. Seems pretty straightforward. Okay, good. I thought it would. Yeah, there's a fair amount of material. That's probably the most challenging part. Well, that's what I've got for you today. So have a good one, and I will look forward to seeing you on Wednesday. Take care.
Thank you, Professor.
Bye-bye, Mary. Thank you. Bye-bye,
Later.
Carolina. Thank you.
Bye, thank you.
Thank